I think we're going to have, though, a squeeze that will be not just related to debt, but even more importantly, related to pensions and healthcare obligations.
Hey, what's going on, guys? Federal Reserve just recently announced an emergency rate cut on hoping to continue inflating the stock market bubble. In this video, I'll explain this current rate cut, and we will take a look at how Ray Dallio's $1.5 billion bet against the market played out. The Federal Reserve executed an emergency half percent point rate cut and the market slide yesterday, reflecting fear of the outbreak is rising recession risk for the US and global economy. The Fed reduced the Fed fund rate to the range between 1% and 1.25%. This is the first time since 2008 financial crisis the Fed cut rate by 50 basis points. In 2008, they had to cut rate due to those derivatives that covered up toxic subprime mortgages, which eventually led to real estate bubble bursting. During that time, we had three significant rate cuts. One of them was by 75 basis points and other two were by 50 basis points. But this time is different. They cut rates by 50 basis points, but stock market still dropped by 3% yesterday on that news. Let's take a look at this video.
Reserve cutting interest rates by 50 basis points, making a surprise announcement of a 50 basis point rate cut. The fundamentals of the U.S. economy remain strong. The statement saying, in light of these risks and in support of achieving its maximum employment and price stability goals, the Fed decided to cut interest rates. Fed say it is monitoring the situation. I think it's been since January 08 or so since you had a rate cut this size, but the Federal Reserve announcing that it is cutting interest rates by 50 basis points to a new target range of 1 to 1.25%. Once again, a 50 basis point rate cut from the Federal Reserve following that G7 meeting, guys, which pledged there would be action. And here it is. I was a little surprised that markets were disappointed. The G7 never takes action. The action is done just like this by individual central banks, individual finance ministries. This is the first action. We'll, I guess, wait to see right now if other shoes drop, including the ECB, the Bank of Japan, as well as other fiscal authorities out there.
The news Federal Reserve said that fundamentals of the US economy remain strong. If the fundamentals of US economy remain strong, why cut rate in the first place? And no, they did not cut rate by 0.25%, they cut rate by 0.5%, which has not happened since 2008 financial crisis. Actions speak louder than words. The act the Fed just did raises a lot of questions regarding Fed's integrity and the current state of US economy. Here is why, on my humble opinion, the use of monetary stimulant and cut rates was a bad idea. The reason they cut rate is because they're afraid that this outbreak could be a needle that popped the stock market bubble. But let's be honest here, despite that the interest rates are currently almost at zero, how is cutting interest rate going to increase consumer confidence if there is a deadly outbreak that threatens community? Let me just give you a quick example. If I know that in my community there is a high rate of infected people, do you think those rates somehow going to convince me to go visit those gathering events such as sport events, concerts, bars, clubs, and even shopping malls? No, I'm not going to do that. Monetary stimulants cannot directly boost consumer spending and consumer confidence, especially if there is a major concern regarding people's lives. One of the greatest investors in the world, Ray Dallio, believes that we are currently in the final stages of this debt cycle. Let's take a look what he has to say about our current economic state.
So where are we in the current debt cycle? You often hear lots of talk about debt. Obviously, we're now 10 years, as you note, past the financial crisis, but debt still comes up. The deficit is ballooning in the United States. Where are we in the cycle?
I think that there are 6 stages to the cycle. I'm going to touch on them briefly. There's the early part of the cycle where debt is being used to create productivity, incomes, and then it can be serviced well. Asset prices go up. Everything is great. And then you come to the bubble phase of the cycle. And in that bubble phase, you're in a position where everybody extrapolates the past. Because asset goes up, they think its assets are going to continue to rise. And you borrow money, and they leverage. And when you are in that phase, when we do the calculations, you could start to see that maybe you won't be able to sustain that level of debt growth. Then you come into the third phase of the cycle, which is the top. That's typically the part of the cycle when central banks start to put on the brakes, tighten monetary policy, and the like. Then you come into the down leg. When interest rates hit 0%, you come into a depression part of that cycle because monetary policy doesn't work normally when interest rates hit 0. Then you have to have quantitative easing, and you begin that expansion, and then you carry that along, and you begin the cycle, carry that. So I think the period that we're in is very similar to the period that we were in the 1930s. If I may, I'll
absolutely
explain it. Okay. There are only 2 times in the history of this century where we had debt crises in which interest rates hit 0. And in both of those times, the central bank had to print money and go to a different type of monetary policy, which we call quantitative easing, and to buy financial assets. And that drives up, in both of those cases, the value of those financial assets and produces a recovery. But it drives interest rates down to 0 or near 0, where they are around the world. And that buying, in this case, $15 trillion of financial assets, has pushed up financial assets and driven the interest rates down to 0, so it's caused asset prices to rise. It's also caused populism, more populism, because that process creates a gap between the rich and the poor. Those who have more financial assets see those asset prices go up, and for various other reasons, a wealth gap has developed. If you look at right now, the top 1/10 of 1% of the population's net worth is equal about to the bottom 90% combined. That's very similar to the late 30s when we had that stimulation and so on. So we're in a situation where we're in the part of the cycle, later part of the cycle, where quantitative easing has been used most of its energy, asset prices are up, interest rates are low, and we're beginning a tightening of monetary policy, very much like we began in 1937. And we have a political situation in terms of having more of a conflict between the rich and the poor, which is bringing out a populism. Populism around the world is the selection of strong-minded leaders who are sort of take charge, but tend to be more nationalistic. And so we're in that type of position.
And you've written extensively and articulately about what happened after 1937, which is we went through a real surge of populism and nationalism and got to World War II and all the horrible things that happened there. What do you think happens now, given where we are?
I think the cause-effect relationships are analogous, meaning that if you have a wealth gap and you have a downturn in the economy where you're sharing the pie, how do you divide a budget? You're sharing the budget. There's a risk that both sides are at odds with each other. And there's also a greater international risk and tensions. Economic tensions produce global tensions for various reasons. So I think that in this expansion, we're about in the 7th inning of a 9-inning game, let's say. We're in the later part of the cycle, the part of the cycle in which monetary policy is tightening and there's not much capacity to squeeze out of the economy. And that as interest rates tend to rise, if they rise faster than is discounted in the curve, it can hurt asset prices. And asset prices are fairly fully priced at this level of interest rates. At some point, we're going to have a downturn because that's why we have recessions. Nobody ever gets it perfectly. And my concern is what that downturn would be. I think that that's not immediate. We don't have the same pressures, but I think it's maybe it's in 2 years, I can't say. Going forward, in a downturn, monetary policy will not be able to be as effective as it was last time. So we have to be cautious about a downturn. I would say err on the side of having a little bit more leeway. And then we have to be concerned about the wealth gap and the consequences geopolitically. I think we're going to have, though, a squeeze that will be not just related to debt, but even more importantly, related to pensions and health care obligations that will happen. So I think these will be difficult times, not immediately, but I think in maybe a few years. And I think it will be very dependent on how we are with each other.
That interview was filmed in 2018, and he said that he cannot really say when the next economic downturn is going to be, but most likely it's going to play out in 2 years or so. We are currently in 2020. 2 years is about to pass. Ray Dallio also believed that unlike 2000's dot-com bubble and 2008 housing bubble, we basically took elevator down when stock market crashed, but this time we won't necessarily take an elevator down. It will be a more gradual squeeze that isn't only related to debt, but also to pensions and healthcare obligations. Back in 2018, during that interview, he did not say out of nowhere that he believes some downturn in our economy will happen 2 years later. He didn't just talk the talk, he also walked the walk. In November of 2019, he took action and hedged his portfolio against the stock market. Let's take a look at this video.
Hedge funds are getting out of the market. That's right. Some of the biggest in the entire world are slowing down or even shutting down and saying there's something about this economy that just isn't right. We're going to begin with news about what some call an impending economic slowdown, recession, or worse. This time, though, the news is not about numbers. It's about names. I'm going to give you some of them. Ready? Jeffrey Vinnick, John Paulson, Leon Cooperman, Ray Dallio, Louis Bacon. They're not presidents. They're not famous politicians. They're not sports figures. They're not celebrities. But they're probably more powerful than all of those. They own some of the biggest hedge funds in the entire world, and they are signaling on this day that there's just something not right about the investment climate that's going on around the world. Boom Bust host Christy I has been following this trend for us. She comes from the world with experience on Wall Street and specifically with hedge funds, and she's good enough to share some of her wisdom with us. So, Christy, what are these guys collectively saying to us?
Absolutely. We have consumer debt level at all-time highs, and we have corporate debt at all-time high. 40% of those corporate debt are actually at risk of default if there is a significant slowdown in the economy. And that's something that Ray Dallio has been saying. He, as you said, the market has gone crazy was something that he was quoted saying.
Right.
And just today, he has placed $1.5 billion in bets in put options with a notional of $100 billion.
What does that mean?
Saying that
he's betting against the market?
Against the market, that by March of next year, if the market goes down, he'll make money. He's betting against the market, saying that we are at risk of a major fallout.
As Wall Street Journal indicated in November 2019, that Bridgewater makes $1.5 billion option bet that market will fall by March 2020. This headline could be a bit misleading since Ray Dallio did not bet his entire portfolio that market will fall. He bet only $1.5 billion of option contracts, which is of course a lot of money for us, but for him, it was only 1.5% of his portfolio. Let's see how Ray Dallio's bet played out. He bought a number of put options on few different ETFs that are tracking different indices, with expiration date sometimes in March 2020. The main ETF was SPY, which is tracking S&P 500 index fund. Let's see what happened to that index from November until the current date. In November 2019, S&P 500 was trading at around $3,100 a share. Then it reached all-time high last month, which was over $3,400. Few days later, it sharply dropped slightly below $2,800 and lost more than 15% from its all-time high. We do not know what the strike price of the option was, But in that article, it said that if stock market drops below the current price of the market, then Ray Dallio will make money. Well, stock market indeed dropped below, but we do not know if Ray Dallio exercised his option a few days ago when S&P 500 was below $3,000. Let me know what do you guys think about these recent rate cuts and Ray Dallio bets against the market. Leave your thoughts in the comment section below, hit that like button and subscribe.